Silver is surging out of a downtrend that lasted for months, out of a silence that very few investors were paying attention to. And what happened this week might be the first sign of something much bigger than one good trading session. Because behind the charts, there's a number quietly making the rounds among analysts right now. A number tied to silver's relationship with the stock market itself. A number that, if history repeats, doesn't point to $60 or $70. It points somewhere that sounds almost unbelievable today. At the same time, on the other side of the world, a central bank just made its largest single monthly gold purchase in years, while a far more uncomfortable story is unfolding around the country, holding more US government debt than any other nation on earth, a country that may no longer be able to sell what it holds. What does that mean for the dollar in your pocket? And for the price of silver in the months ahead? Stay with us. Because by the end of this video, you'll understand exactly why serious investors have stopped calling this a rally. They're calling it the beginning. Welcome to Currency Arc Insight, the channel built for decoding the economic signals shaping the future of money, markets, and wealth. If this is your first time here, hit subscribe so you don't miss the next warning before it turns into tomorrow's headline. And tell us in the comments, where are you watching from today? For months, the precious metals market sat stuck in a holding pattern that tested even its most patient investors. Silver drifted sideways. Gold, after its earlier run, spent week after week digesting gains instead of building on them. Analysts argued over whether the bull run had stalled out or just paused for breath. Then, in the space of a single trading week, that argument was settled. Silver tore through resistance levels that had capped it for months, pushing decisively higher, confirming what a lot of technicians had only whispered about privately. Gold followed close behind, climbing toward $4,400 an ounce and breaking a downtrend line that had defined its path since the correction began. Look at the one-year chart and the shift is obvious. What looked like fatigue now looks like accumulation. What looked like weakness now looks like preparation. This is exactly the moment when casual observers start paying attention, and not coincidentally, the moment serious investors get most cautious. One strong week doesn't confirm a new trend on its own. Markets produce sharp countermoves inside bigger corrections all the time, and history is full of breakouts that got retested, pulled back, or reversed outright. The real question isn't whether the move happened. It clearly did. The question is whether what's driving it is structural or just temporary. That distinction matters more in precious metals than almost anywhere else in the markets. Gold and silver don't move on quarterly earnings or corporate guidance. They move on confidence in currency systems, on shifts in real interest rates, on what central banks are buying, and on the psychology of investors, either chasing safety or fleeing it. A breakout built on pure speculation tends to fade as fast as it showed up. A breakout built on something deeper tends to be the first visible sign of a much longer move already underway. That's why the charts, as significant as they are, can't be read on their own. They show that resistance broke. They don't explain why. To understand why, you have to look past the price action itself, toward what's actually feeding it. How professional analysts who track these markets for a living are positioned right now, where capital is flowing between asset classes, how the world's biggest gold buyers are accumulating, and what's happening to the currency still anchoring the entire global financial system. Each of those threads points in the same direction, but each carries its own weight of evidence, and each deserves its own look before drawing any real conclusion about what comes next. Here's what can be said with confidence right now. The passive, sideways phase of the gold and silver market is over. Whether it ends in continuation or correction is exactly what the next several weeks and months will reveal. What's already clear is that the assumptions a lot of investors were holding about this sector just a month ago no longer describe the environment they're actually in today. The charts opened the door. What's behind that door is a set of signals most casual market participants aren't tracking closely, and a smaller number still fully understand. Some come from technical analysts, whose frameworks have called major turning points before. Others sit buried inside ratios comparing precious metals not to each other, but to the broader stock market itself. And one signal, arguably the most consequential of all, isn't coming from a chart at all. It's coming from the deliberate, sustained buying of a central bank on the other side of the world. That's where we go next. Something has shifted in how technical analysts who specialize in precious metals are talking. For months, the tone was hedged, conditional. Analysts spoke of possible bottoms, levels worth watching, scenarios that might unfold under the right conditions. That language has changed. Since this week's breakout, several respected chartists have dropped the hedging entirely and started saying it outright. The correction, as far as they're concerned, is over. That confidence isn't coming out of nowhere. It's grounded in historical pattern recognition, a discipline that carries real weight among professional technicians, even though it guarantees nothing. One pattern getting cited repeatedly involves gold mining stocks after periods of severe, extended decline. Historically, when mining equities jump more than 15% in a single week following a deep drawdown, that move has often marked the start of a durable recovery rather than a temporary bounce. Analysts point to similar episodes in 2008 and 2016, periods of real market stress followed by sharp reversals that went on to hold. This week's mining rally fits that profile closely, which is a big part of why analysts have grown comfortable saying their case out loud instead of keeping it to themselves. A second, more unconventional signal has emerged from the ratio between silver's price and the level of the Nasdaq composite. This ratio measures how much silver a single unit of that tech-heavy index can buy, giving a way to compare hard assets against the benchmark that's dominated investor attention for the better part of a decade. At its most recent extreme, back in 2011, that ratio sat dramatically higher than where it stands today. Apply that historical ratio to current Nasdaq levels, and the implied silver price comes out many multiples above where it's actually trading. That doesn't mean such a price is coming soon, or even likely in the near term. It does mean that, by this specific historical measure, silver remains significantly undervalued against the equity market everyone's been watching instead. A related ratio backs up the same conclusion from a different angle. Silver mining stocks against the price of silver itself. That ratio also sits well below where it was at the 2011 peak, suggesting mining equities haven't come close to pricing in the kind of silver valuation history says is possible. Two independent ratios measured against two different benchmarks landing on the same conclusion. That kind of convergence is exactly what pushes analysts to speak with more conviction than they have in months. None of this proves what happens next. Ratios that hit extremes in 2011 aren't guaranteed to hit those same extremes again. 15 years of structural change separate that period from today. Markets don't have to repeat their own history just because a pattern showed up once before. What these signals do offer is context, a reason why analysts who spent months hedging are now speaking with a directness that reflects real conviction rather than promotion. For serious investors, the value here isn't blind acceptance, it's recognizing what's actually changed. A narrative built on hope is fragile. A narrative built on converging historical evidence, coming from analysts with real track records, carries more weight. The technical case for a durable bottom in gold and silver has moved from a minority view to something close to consensus among the people who study these markets full-time. Still, technical analysis alone has never fully explained a structural shift in precious metals. Charts and ratios describe price behavior. They don't explain the capital flows producing that behavior in the first place. To understand those forces, the focus has to shift to where the money is actually going, and why an entire asset class ignored for over a decade might be pulling in a level of institutional interest most casual observers haven't noticed yet. Beyond the charts and the ratios sits a different kind of evidence. The raw performance numbers posted by precious metals mining equities this week. These are hard to wave off as noise. The leading gold miners ETF climbed roughly 20% in 5 trading days. The Junior Gold Miners Fund, which tracks smaller, higher-risk exploration companies, climbed even further, above 23% over the same stretch. Moves that size, packed into a single week, are rare anywhere in the equity market, and especially rare in a sector that had spent most of the past year going nowhere. What matters isn't just the size of the move. It's what it typically represents. Sharp, broad-based rallies in mining stocks are often read by professional investors as evidence of capital rotation, money moving out of one asset class and into another. For years now, that capital has piled heavily into large technology companies, particularly anything tied to AI infrastructure. By a lot of historical measures, those valuations look stretched. When a rotation like this week's shows up, it often signals that some of that money has started hunting for value elsewhere. And commodities, including precious metals, are one of the first places it tends to land. It's worth being clear about what this rotation doesn't represent yet. The capital that's flowed into mining equities this week is a small fraction of what's currently sitting in large tech holdings, but even a modest shift out of that sector, redirected into a commodity market as comparatively small as precious metals mining, would represent an enormous new source of demand relative to the size of that market today. That's the asymmetry driving analysts to treat this as an early stage, rather than something already played out. A rotation like this doesn't need a mass exodus from tech stocks to produce an outsized effect on mining equities and metals prices. It just needs to continue. That dynamic gets reinforced by participation data. By most estimates, only around 1 to 2% of investors hold any meaningful allocation to gold, silver, or related mining stocks. This is a sector that's spent over a decade sitting outside the mainstream investment conversation, overshadowed by the far bigger, far more heavily promoted tech and growth markets. Analysts who track sentiment note that this low participation is itself worth watching. Historically, asset classes with extremely low public awareness and thin institutional allocation have offered the widest asymmetry between risk and reward. precisely because so little capital has been deployed into them yet. There's a long runway before this sector even approaches historical norms of participation, let alone anything resembling speculative excess. Put together, these numbers describe a market in an early, under-recognized stage of a bigger shift. The mining rally this week wasn't an isolated technical blip. It lines up with the valuation signals from the last section, with the ratio analysis pointing to deep undervaluation, and with a broader environment where capital appears to be testing a sector. It's ignored for years. What domestic market data alone can't explain is the international side of this story. Rotation inside markets like the NASDAQ and the mining sector reflects investor behavior. It doesn't account for the deliberate, sustained accumulation being carried out by the world's largest sovereign gold buyers, accumulation that's been building quietly for months, mostly outside the attention of Western financial media. And that may be the most consequential piece of this whole story. That's where the analysis turns next. While Western financial media has stayed focused on stock rotation and mining stock performance, a separate and arguably bigger story has been building on the other side of the world, drawing far less attention than its scale deserves. China, the world's largest gold-consuming nation, has been steadily and deliberately building its gold exposure, both at the institutional and household level, for months. Chinese gold-backed ETFs have posted 14 straight days of net inflows, the longest streak recorded since earlier this year. That's not a market reacting impulsively to one good week. Inflows sustained that long usually reflect a broader shift in sentiment and positioning, one that's been building gradually rather than appearing out of nowhere in response to this week's breakout. At the institutional level, the signal is even more direct. The People's Bank of China bought roughly 20 tons of gold in a single recent month, its largest monthly increase since 2023. That purchase extends a run of 21 consecutive months of accumulation, even through a stretch when prices fell nearly 30% from earlier highs. Rather than pausing during that decline, the central bank appears to have used the lower prices to accelerate its buying, a pattern that looks a lot more like long-term strategic reserve building than short-term opportunism. This isn't unique to China either. Global data on physical gold-backed ETFs shows inflows above $3 billion in a recent month, the largest monthly intake since earlier this year. Those inflows span North America, Europe, and Asia, which points to a demand base that's broadening, not narrowing. After several months where outflows dominated across various regions, the swing back into positive territory almost everywhere marks a real change in the global demand picture. To understand why this matters, look past the tonnage figures and toward what usually drives this kind of sustained sovereign buying. Central banks don't buy gold casually. Reserve decisions at this scale come from long-term strategic planning tied to currency stability, geopolitical risk, and doubts about the reliability of existing reserve assets. When a central bank accelerates its gold buying during a price decline and keeps that pace up for nearly 2 years, that's a level of conviction that goes well past routine portfolio rebalancing. China's own relationship with gold adds another layer here. Gold and silver have long held a distinct role in China as stores of value, especially given the limited alternatives available to individual savers. Real estate, historically the go-to for household wealth, has run into serious headwinds in recent years. Crypto access remains heavily restricted. Against that backdrop, sustained demand from both institutions and households reflects a broader search for something reliable to hold onto inside an economy dealing with its own structural strain. Put it all together, and the picture is one of accumulation that predates this week's breakout by months. The technical signals, the mining rally, the capital rotation, all of it may explain the timing and size of the recent move. None of it fully explains the foundation underneath it. That foundation appears to rest, at least partly, on a sustained, deliberate buying pattern from the world's largest gold-consuming nation and its central bank, one that's continued regardless of short-term price swings, which raises a bigger question than any single country's buying habits. Why would a major central bank commit to this pace of accumulation for almost 2 straight years, including through a period of falling prices? The answer connects to a much larger, much more consequential story, one involving the stability of the world's dominant reserve currency and the mounting pressure on the largest holders of its government debt. That's where this ends. Underneath the breakout, the mining rally, and China's sustained buying cites a structural problem tying all three together, mounting pressure on the US dollar's position as the world's reserve currency, and specifically, the bind facing the largest foreign holder of US government debt. Japan holds more US Treasury securities than any other nation on Earth. Under normal circumstances, that's a straightforward creditor relationship. But Japan's own currency has been under sustained pressure for years, and reports indicate U.S. monetary authorities have stepped in to support the yen rather than let Japan sell off a meaningful chunk of its treasury holdings to defend its own currency. The logic is simple enough. A large-scale Japanese sale of treasuries could destabilize the treasury market itself. At a moment, the U.S. can least afford that. That creates a real paradox at the core of the reserve currency system. A reserve asset is supposed to be liquid, sellable when it's needed most. Yet the largest foreign holder of that asset appears constrained from selling it, even under its own domestic pressure, because doing so risks destabilizing the very system that asset is meant to protect. That's not a minor technical footnote. It cuts at the core function reserve currency status is supposed to provide. The scale of the broader challenge makes this worse. The United States needs to refinance several $1 trillion in maturing government debt over the coming year, on top of an annual deficit, requiring several trillion more in fresh financing. Combined, the total financing need lands somewhere between $10 and $11 trillion in a single year. Meeting that requires finding buyers willing to absorb that volume of new and refinanced debt, right when one of the traditionally largest buyers is boxed in. When a government has to expand its money supply or lean on continued central bank support just to manage its debt obligations, the practical result is a gradual erosion in what that currency can actually buy. This isn't a prediction of sudden collapse. It's a description of a mechanical relationship that's repeated throughout monetary history. Currencies under sustained debt and financing pressure tend to lose value over time, and assets priced in that currency, gold and silver among them, tend to rise as a reflection of that erosion. That's the backdrop this week's breakout needs to be read against. The technical signals were real, the mining rally was real, China's accumulation was real. But underneath all of it sits a currency system under genuine structural strain, one that sophisticated buyers, from central banks to institutional investors, appear to be positioning against well ahead of any broader public recognition of the problem. For anyone tracking the intersection of currency stability, sovereign debt, and hard assets, this week's price action wasn't the beginning of the story. It was simply the moment the story became visible.